So the GameStop stock is pumping this morning because yesterday on Sunday, Roaring Kitty revealed that he has $65 million worth of open call positions at $20, and those expire in 3 weeks on June 21st. And so the stock went up as high as 94% this morning. And I want to make this quick video, guys, just to warn retail investors not to get lured into the FOMO, because yeah, there is a way to make a quick buck in this rally. However, if you zoom out, just zoom out a little bit, look at this over here. The stock, the close price was $81, but it rallied at some point to over $400. And even if we look at 1 month over here, when Roaring Kitty came back, it says the stock closed at 49, but in fact it went up as almost as high as $80. And the problem with all of this is that the hedge funds, the evil hedge funds, I am with you. They manipulate the market. The fact that they're losing money on shorting GameStop is not such a bad thing, because they actively manipulate the market, so they deserve it. But the problem is that retail investors, usually people with not a lot of disposable cash, disposable income, they want to get a piece of the pie, and they see a get rich quick scheme, and they jump in. But then they start waiting for that extra 50 cents. They want to make a couple more bucks, and they'll end up losing it all, and that's very unfortunate. And I really don't want you to be that guy, because at the end of the day, Roaring Kitty has $100-some million right here, $116 million in the stock of GME, of GameStop. But for him to actually get that money, he needs to sell it. And who's going to be buying it? Trust me, it's not going to be the hedge funds, because hedge funds, they're not dumb. They play both sides. They short and they go long. And guys, this company GME, it's not a very good company as far as the business goes. And I'm all for the getting even, but ultimately this stock is not worth $30 that it's sitting at right now. And eventually this whole hype will die down, as we can see over here. It went up really high during the GameStop craze, the meme stocks, but it went down to $10. And it's going to happen again, and it's going to be the retail investors holding the bag, because this company, so last quarter they showed 21-cent EPS, but look at this chart. Like, this is insane. It's all negative. It's all in the negative. They're losing money. They have 3 positive quarters as far as EPS since 2020. Like, this is ridiculous. Look at their free cash flow. Free cash flow negative. They're not making money. The business is pretty poor. Like, yeah, they just did a they just sold $2 billion worth of shares that they created out of thin air, basically diluting shareholders. And they have a pretty decent cash position, and like the debt over here has not updated yet. They sold another $2 billion worth of stock, so now they're sitting on $3 billion. But as far as business, you can look at the revenue. It's declining. Like, over here it was growing into 2005, 2006, it was growing, and then it stopped in 2011. And since 2011, when it peaked, it has been declining. It's a dying business. It's not gonna go anywhere long term. So don't get stuck, buying the shares at $30, $40, $50 when it runs up, and then you're going to be an exit liquidity for the smart money, even for Roaring Kitty. Like, he'll sell at the top and disappear for another 3 years, and then when he feels like the stock came down enough, he'll post another tweet, another meme, and the whole thing will start again. But the exit liquidity are the retail investors. Yes, there is a couple of hedge funds that will lose a few billion here and there, but overall, all of this is retail investors. And this stock was worth $4. Over here it was $1. All of a sudden it did not become a $30 stock or a $100 stock. So don't be the exit liquidity. Be careful. There are better ways to make money in the stock market. Yes, it requires discipline. It requires long-term investment mentality. But look at Warren Buffett. He has made it. For example, if we look at Berkshire Hathaway, the Warren Buffett stock, like, yeah, the stock was $631,000, but today it was actually $185. Anyway, so the stock is up 232% in the last 10 years. It's slow, it's tedious, it drops sometimes, but if you invest in quality companies, you will see the return. Let's look at SCHD. The return in 10 years is 183%, and you're also getting a really nice dividend, and it's growing every year. It's growing. You can see this CAGR, this green bars over here. The stock is growing nicely, and the dividends are always increasing. So I'm not telling you to invest in SCHD. I'm going to make a separate video on this dividend ETF, but just to reiterate the point, like, yes, you might end up making crazy money on the GameStop, but chances are, and the majority of people who actually dive into this stock, they end up being the exit liquidity. They lose the money, they buy in at $50, at $100, and then, you know, they're sitting and waiting for that 50 more cents, but then the stock just crashes and they end up sitting on a loss. Eventually they sell and never touch this thing again. And a lot of people lost their, you know, like their retirement money, their their livelihood, and it's just crazy. I don't think people should be jumping into it. So I wouldn't recommend anyone. Like, it's not an investment advice, and this is definitely not an investment vehicle. This company is losing money. It's just a gamble, and if you get into it, just be careful, guys. Don't be exit liquidity for Roaring Kitty and for the hedge funds. I'm not saying they're working together, but in the end they both profit, and the regular retail investors end up holding the bag that never materializes. Okay guys, good luck, thanks for watching, and if you enjoyed this video, please subscribe to the channel, click the like button. It really helps with the algorithm. It helps our brand new YouTube channel grow. So thanks for watching, appreciate it, and I'll see you in the next video.